Good morning, everyone.
Good morning.
Everyone's here already.
Yes.
I'm glad to welcome all board directors for here at AGM this year, 2024. I hope everyone willing to contribute well for meeting today. Who's present for meeting today, Huda?
Alright. I am myself as cash manager, and so here we have Nur Izzati as account receivable manager and her assistant Darun Nur Atika.
Yes.
Bushra Aisha as investor relation officer and her assistant Nur Adira. So Izzati will be answering all our agendas today. What the objective today, Izzati?
Today's objective, we will be presenting statement of financial position of our company, Gagasan, Nadi, Cergas.
That was thorough preparation, but let's start by reviewing our liquidity ratios. Our current ratio has dropped from 2.24% in 2022 to 1.61% in 2023. So I must suggest that our ability to cover short-term liabilities with current assets has weakened. Similarly, our quick ratio decreased from 1.82% to 1.17%. in 2023 to 2022, meaning even when we excluding inventory, we are less capable of meeting short-term obligation quickly. Lastly, our cash ratio improved slightly from 0.39% to 0.47%, indicating a small increase in cash or cash equivalents relative to current liabilities, but it's still on the low side. We need to address this downward trend to ensure financial stability. That's for now. Next, I want to hear about company's cash flow. How is it? Cash management, is it okay?
Building on that, I have analyzed that the cash flow statement is clear, and we have been facing deficit in operating cash flow, primarily due to delayed collection and rising expenses. While there's a slight surplus from investment activity due to asset sales, it's not sustainable to rely on this one-off gain. We need to tighten our cash flow management to create a more reliable operating cash flow stream. What do you think, Ika?
Okay, I will review our credit policies, and we have been too lenient with our payment terms. Our average collection period has stretched to over 60 days, significantly impacting our liquidity. By revising our credit policies, shortening terms for new contracts, and aggressively following up on overdue accounts, we could free up significant working capital. I also suggest exploring this one for early payment to incentivize faster collection.
Okay, for me, I think we also need to prepare our communication strategy for our stakeholders. Transparency is key. I propose framing the liquidity challenge as a temporary issue and pledging our commitment to resolving it. Highlight proactive steps such as revising credit terms and potentially secure a short-term loan can reassure stakeholders of our strategic approach. Additionally, we should focus on the slight improvement in the cash ratio as a positive signal.
That's good. Next, we're moving to working capital management. Let's dive into our liquidity analysis. For 2023, our working capital stands at 122,527 ringgit compared to 2022, which is 231,107 ringgit. This shows a significant drop, which may affect our ability to cover short-term liabilities efficiently. The current ratio has also declined from 1.8% in 2022 to 1.4% in 2023. This indicates we still have enough to cover liabilities, but the buffer is shrinking. The quick ratio, however, is concerning as it's below 1.0, suggesting potential liquidity challenge if we don't act swiftly.
I have analyzed the cash flow statement, and here the issue. While our operating cash flow remains positive, we have seen delays in cash inflow from receivable. At the same time, our cash outflow for payable and operational expenses remain consistent. This mismatch is creating pressure. Addressing this will free up much needed cash, which can be directed toward investment or operational flexibility.
Well, building on that, I believe that delays are largely due to lenient credit policies. Our average collection period has stretched to 65 days from 50 days last year. If we tighten our policies and follow up more aggressively with clients, we can reduce this lag. Even a 10-day improvement could significantly enhance cash flow.
Alright, it is true, but we also need to keep stakeholder informed. Investor might interpret our reduced working capital as a sign of financial strength, especially with the drop in liquidity ratio. I suggest we communicate this strategically, highlighting our plan to optimize the cash conversion cycle. We should emphasize our step to strengthen receivable collection and our ongoing investment in growth.
Great insight, everyone. So here's the plan, which is cash measure work with account sale manager to refine collections. So let's aim for that 10-day improvement. So investor relation prepare a statement for stakeholder emphasizing proactive measures and commitment to financial health. So we will revisit the liquidity analysis next quarter to evaluate our progress. Starting with the debt to equity ratio, it stood at 96.22% in 2023, a significant improvement from 120.40% in 2022. This indicates a reduction in reliance on debt relative to equity, suggesting a lower financial risk compared to the prior year. Moving to the debt to assets ratio, it was 0.949% in 2023, down from 0.55% in 2022. This reflects a slight decrease in the proportion of assets financed by debt, signaling a healthier balance sheet. Finally, the interest coverage ratio has improved from 0.37% in 2022 to 1.21% in 2023. While still low, this enhancement means the company is better positioned to cover its interest obligation with its earning. However, the ratio remains below the ideal threshold, which warrants caution. I think it was okay.
Thank you, CFO. From the risk perspective, the improving trend in this ratio are encouraging. However, increasing leverage poses several risks. Firstly, while the interest coverage ratio has improved, it remains vulnerable. Should revenue decline or interest rate rise, the company's ability to meet its obligation could be compromised. Secondly, higher leverage could strain financial stability and limit the company's future borrowing capacity. If debt level rise, creditor might demand stricter terms, which could impact cash flow and operational ability. We must also consider potential economic downturn or industry disruption, which could exacerbate financial pressure.
Building on the risk manager's point, I have researched industry benchmark for leverage ratios. For companies in similar industries, the average debt to equity ratio is around 75%, suggesting Gagasan, Nadi, Cergas, Berhad is slightly above the industry norm, but showing progress toward alignment. Next, I will pass to Atira.
Regarding the debt to assets ratio, the industry standard is approximately 0.45%, meaning the company carry ratio of 0.49% is competitive. For the interest coverage ratio, a value about 2.0% is generally considered safe. Gagasan, Nadi, Cergas, Berhad is still below this benchmark, which is 1.21%, highlighting the need for further improvement in earning relative to interest expenses.
Well, from an operational standpoint, taking on additional debt could enhance short-term liquidity, allowing us to expand and invest in new technology or infrastructure. However, increased debt would reduce operational flexibility as more cash flow would be tied up in debt servicing. This could hinder our ability to respond to unexpected opportunities or challenges.
Alright, I will continue the explanation. In the long term, high leverage might constrain growth prospect by limiting resource available for reinvestment. To mitigate this risk, we should ensure any new debt is strategically aligned with projects that promise high return, and maintain a prudent approach to leverage. Right, Steve? That's all I have to say.
Thank you everyone for your insights. It's clear that while Gagasan Nadi Berhad has made progress in managing its leverage, we must carefully weigh the risks and benefits of taking on additional debt. A balanced approach will be crucial to support sustainable growth while maintaining financial stability. I think that's all. I will evaluating our efficiency ratios. So our asset turnover ratio improved from 2022 to 2023, which 0.23% to 0.36%, indicating a slight improvement in how effectively we're using our asset to generate our revenue. But our inventory turnover ratio dropped significantly from 2.43% in 2022 to 1.16% in 2023, reflecting a slower movement of inventory. However, receivable turnover ratio increased from 2.60% in 2023 to 2022 to 3.54% in 2023. So I will be evaluating efficiencies ratio of our company. So our asset turnover ratio improved from 2022 to 2023, which is 0.23% to 0.36%, indicating a slight improvement in how effectively we're using our asset to generate our revenue. But our inventory turnover ratio dropped significantly from 2.43% in 2022 to 1.61% in 2023, reflecting slower movement of our inventory. However, receivable turnover ratio increased from 2.60% in 2022 to 3.54% in 2023, suggesting improved efficiency in collecting payments from customers. While some areas have shown progress, the decline in the inventory turnover ratio is a concern. Let's explore strategies to address this and boost our overall efficiency. Supply chain manager.
Well, the drop in the inventory turnover ratio points to overstocking or slower sales. To address this, I propose that we implement just-in-time inventory. This minimizes holding costs by aligning stock levels with demand. Buddha, can you please do it?
Okay, we need enhancing demand forecasting to utilizing predictive analytics to improve accuracy in stock planning. Then I think we need to improving supplier collaboration, streamlining procurement processes to reduce lead time. These changes can significantly enhance inventory management and drive operational efficiency. So sales manager.
Alright, thank you, supply chain manager. Now, declining sales are another critical factor that impacting our efficiency ratios. To address this, we need to focus on improving our sales strategies.
One way to do this is by advertising high demand products. By allocating more resources to promote and stock this item, we can drive sales more effectively. Another area we should explore is a personalized market campaign, engaging with customer on personal level through loyalty program or target promotion. Also, we can encourage repeat purchase and attract new customers.
Lastly, expanding our distribution channels can help us reach untapped markets. For instance, increasing our online presence or partnering with others retail platforms can boost accessibility and in turn revenue. This step should directly improve both our sales and overall asset utilization. I completely agree with the strategies outlined so far. However, we mustn't overlook the role of our workplace in driving efficiency. Employees are the backbone of all operations, and their productivity directly impact these ratios. To enhance workplace productivity, we need to invest in training programs that focus on improving their skills, especially in process optimization and technology use. Introducing performance-based incentive could also motivate employees to exceed expectations. Additionally, automating repetitive tasks will free up their time to focus on higher value activities.
Thank you everyone for your insights. It's clear that we need a combined approach to address these challenges. So let's work together to strengthen our efficiency and ensure sustained growth for Gagasan Nadi Cergas Berhad. So we are at our last segment, which is analyzing profitability ratios. As you know, the company's profitability ratios are below industry standards. and we need to develop strategies to improve. So our gross profit margin stands at 10.62% in 2023, a slight decrease from 10.85% in 2022. This indicates marginally higher production costs or reduced revenue efficiency. Next, net profit margin improved from 1.11% in 2022 to 1.75% in 2023. While the improvement is a positive sign, the margin remains low, highlighting the need to control costs further. Return on assets (ROA) increased from 0.26% in 2022 to 0.63% in 2023. So this suggests we are utilizing assets more effectively, but the return is still insufficient. Return on equity (ROE) grew from 0.58% in 2022 to 1.24% in 2023, showing slight progress in generating returns for shareholders. Overall, while we see incremental improvements, these ratios remain significantly lower than industry benchmarks. We must explore strategies to improve profitability and shareholder returns. That's the financial snapshot for now. I want to hear the marketing manager on how current marketing strategy might be influencing revenue and profitability.
From a marketing perspective, we have several areas we need to address. For the first one is pricing. Our pricing strategy align with industry norm but offer little differentiation. For example, we could introduce a premium model pricing for high margin service or discount for volume purchases to attract bulk clients. The second one is market penetration. Our effort to expand into new customer segment or geographic market have been limited. This is a missed opportunity to increase sales volume. The third one is promotion. Current promotional campaigns are too generic. For example, instead of broad discount, we could offer targeted promotion for loyal customer or seasonal deals. To enhance profitability, I recommend to introduce tiered pricing for value-add service, or we can launching aggressive marketing campaigns targeting high potential customer segment, or we can leveraging social media and digital platform for cost-effective promotion. These changes to improve our gross profit margin and overall operational efficiency.
Well, thank you. Our operations currently face two main challenges, which is cost structures. We've seen a slight increase in production costs, which correlates with a minor decline in the cost profit margin. This indicates room for improvement in controlling expenses. Next, operational efficiency. There are inefficiencies in resource allocation and supply chain management. For example, certain processes are manual and could be automated. ICA has prepared ways to improve and face these challenges.
Okay. As what Izaki said, I already have found the way to improve our gross profit margin. Okay, let's start with the first one. The first one is we could implementing lean management practices to minimize the waste. Secondly, we should do an automating repetitive processes such as inventory tracking in order to reduce our labor costs. Okay. And then lastly, we could be negotiating better terms with suppliers to lower our material. Okay. Thirdly, we could be negotiating better terms with the supplier to lower our material costs. Okay. By implementing these changes, we could improve our gross profit margin and overall our operational efficiency.
Okay, certainly after researching industry benchmark, here's what I found. So based on the slide that you can see, okay, for gross profit margin, our 10.62% is below the industry average of approximately 15%. This suggests that while we are managing to generate revenue, our production or operating costs are relatively high compared to competitors. Okay, for net profit margin, at 1.75%, we are also trailing behind the industry average of around 3%. The improvement from 1.11% last year is promising, but we need to focus on strategies to drive this margin closer to the industry benchmark. Okay, for return on assets, our 0.63% lags significantly behind the industry standard of 2%. This indicates that we are not utilizing our assets effectively to generate returns. We may need to assess low performing assets and either improving their performance or divest them. Okay, for return on equity, our 1.24% is well below the industry average of 5%. Shareholders' returns remain minimal, which might deter potential investors unless we take steps to enhance profitability. So next.
And the high margin service, we should prioritize investment in service that have higher profit margin, such as inclusive hospitality package or niche market offering. Asset utilization, our current asset invest in underperforming one. Invest the process into technologies or project that promise better return. Cost control, reducing operational efficiency through automation or process optimization can positively impact all our profitability ratio. Market competitiveness aligns our pricing strategy with industry leader. While understream we maintain a value proposition that stand out. We think this measure will help bridge the gap with our competitor and position us for sustainable growth.
And that's all.
That's all.
So together we will steer the Gagasan dari Cergas Berhad through these challenges as we made our own strategy to build out our company. I think that's for meeting today. Good job.